Hi students. Well, in our continuing a set of videos on EPS, now we're going to look at the Treasury stock method, and this, as you can see on the screen, is used for options and warrants. Now, interesting thing about a stock option when we think about EPS is first, if it's exercised, the company receives money. But as you know, when you issue shares, the money you get is not income. So your income, net income, will not change, or would not change, I guess, if these options had been exercised. You would simply be sitting there with a lot of money, but none of it would be on your income statement, just like selling shares. You get money, cash debit, common shares credit, right? So one of the main concepts around stock options and the concept of them being dilutive is that they are always dilutive, because no one would ever exercise a stock option if the price of the option was higher than the market price of the share, right? You're only going to exercise a stock option if it says here in the money, right? Which means the price of the option is lower than the price of the share. That's a big deal, right? So because there is no effect on net income, and there is an effect on the number of outstanding shares, therefore options have to be dilutive. So if we have a number of potentially dilutive items, we need to make sure that we actually do the options first. So we're going to get basic EPS, and then we're going to do the options. Now, the method is a little strange, but it's actually pretty easy. So we're going to go through this method and have a look at it, and we're going to kind of tie it in a little bit to the previous example. So again, we assume that the options are exercised at the beginning of the year, and of course we assume that the exercise price is less than the market price, because again, no one ever would exercise an option for more than the market price if you could just buy the share for less on the market. So in this example, we have an exercise price of $30. So this means that when the option is exercised, we as a corporation receive 30. Now, the comparison, or one of the key numbers we need here, is the average market price of one share for the year. So notice that this is not the ending market price. It's not December 31, it's the average for the year. And in this example, we have 1,500 options outstanding. And these are going to be, one share per option. So what we need to do then is calculate how much money we're going to get and figure out how many shares. So let's just kind of look at some of these questions. How much money would we receive? Well, $30 is the exercise price, and there are 1,500 options. Now, sort of pivotal to this method is the whole question about what are you going to do with that $45,000, right? It should benefit you in some way, but we know it's not net income, so we cannot add it to the numerator in our EPS calculation. So here's what the accounting profession figured out. We figured out that we would use that money, that $45,000 in this case, to repurchase our own shares, and therefore reduce the 1,500 by the number of repurchased shares. Now keep in mind, this is all imaginary. We're just using a method to calculate diluted EPS. No one really gave us the $30, and we're not really buying back any shares. This is simply a calculation to see how many shares we would end up issuing. So once you kind of get your head around that, it's actually a really, really simple method because, well, the numerator is 0, right? The denominator is all we really need to figure out. So let's just go ahead and figure this out. So we take our proceeds, we take our proceeds, we would have received 45,000 if these had been exercised. There would therefore be 1,500 new shares that had been issued. And the big number here, the question is, how many shares could we have repurchased with the 45,000? So here's the calculation. Here's our $45,000 divided again by the average price during the year. So not the ending price. Make sure you kind of remember that. So 45,000 divided by 50 is 900. So the treasury stock we could have purchased is 900 shares. So if we issued 1,500 and then we repurchased 900 at the market price, we would only end up with 600 more shares. And that's the number we're going to use in our diluted EPS calculation. So keep in mind that 600. Now I'm going to just use the basic EPS figures from the previous video, and we're going to do this table format again, and I think you'll see how slick and easy that is. So here is our basic EPS, the 410,000 divided by 100,000 shares, giving us 410. Options, never a numerator effect. So numerator 0, we still are left with 410. We calculated we would have an incremental 600 shares. So we would now have 100,600 shares, giving us a diluted EPS of 408. Now you may think, wow, that's just 2 cents. It's almost not worth bothering. Well, we have to bother. GAAP says we do. But what I'd like you to sort of also understand is that this is really common. If you look at actual corporate financial statements, quite often diluted EPS is only a couple of cents lower than basic EPS. So it's not necessarily going to be a big deal, but it could be, right? So that's why we have to disclose that number. So that's all there is to the treasury stock method. And in the last video coming up on EPS, what we're going to do is look at one larger example that blends all of these together, and then you'll see how that works.